A very good morning, everybody. Welcome to the Flow Show. It's CPI Day, US CPI Day. So we're going to be looking at those numbers today, see what's what, see what the potential outcomes and likely price moves we're going to get on those. We shall start off, as we often do, with some of the headlines. In China, China's Securities Daily published a piece saying that China's GDP growth may slow in Q3 before improving. So that's likely a bit of a heads up for us. Over in Japan, some interesting comments from BOJ's Noguchi, saying that the biggest focus is whether wage hike momentum will be maintained or not. We haven't. It says raising of the YCC allowance band does not signify a tightening of monetary policy. If the central bank holds rate hikes and inflation comes down, the risk of a hard landing will be reduced. So he's in the camp that if they hike rates and maybe hikes significantly, then they will create some economic problems. Says when inflation expectations are in a stage of rising, some flexibility is needed to continue easy policy under YCC. And speaking back to wages, says 3% nominal wage growth would correspond with a 2% inflation target. So he's put in a bit of a number on how they might get to target as far as wages are concerned. However, says he cannot be optimistic about the acceleration in wage growth. On yields, says longer-term yields rose to 0.8%, mostly due to US yields. So palming it off onto a dragging effect on what we've seen in US yields, putting pressure on JGBs. Now, a bit of an interesting comment. We had rumour that they may be hiking their fiscal year 2023 inflation forecasts, and he's all but confirmed it by saying we have no choice but to raise our inflation forecasts for fiscal year 2023. So we all know those are now going to be going up. The rumour was that they were going near 3%. We have to see what that means. Currently at 2.5%. Do they go 2.7, 2.8, 2.9? Who knows? On the price front, we've had some PPI data out from Japan as well. A little bit stocky on a month, down 0.3%. Year on year, a bit softer, only rising 2% versus 2.3 expected and 3.3 prior. So a bit of softening there from in the PPI front for those guys. Also had some core machine tool orders coming in there, looking a little bit softer than expected, down 0.5 on the month and worse on the year, down 7.7%. So much like we've seen in some of the other manufacturing data coming out of there, as the rest of the world, that side of things still not looking too hot. RBNZ's OR says the official cash rate needs to stay restricted for the foreseeable future. Out some comments overnight, pretty much plugging the same stance that we already know from the RBNZ. Over in the Bank of England, and we've had birds from both sides of the nest out. Dove, BOE's Dinger saying only about 20 or 25% of the rate hike impact has been fed through so far. If the economy falls by much more than it's expected from here, a cut may happen sooner. There we go. We're getting on to the cut talk from her. Chief Economist Peel at the Bank of England says it's a finely balanced issue if the BOE still has more to do. And that UK inflation remains too high. Again, on the data front, we've had some mixed data out, really. GDP numbers for the month showing an improvement, but as expected, up 0.2% on the month, following a negative 0.6% previously. So growth back in the positive zone. The 3-month rolling GDP, you can sort of count that as a 3-month quarterly number, 0.3% again as expected. However, not such good news in the industrial production and manufacturing production numbers. Some strong negatives on the month, down 0.7 for IP and down 0.8 for MP. The year-on-year numbers also looking much softer as well. So again, industrial manufacturing sector, as we know, in a bit of a slump at the moment, and that's now being confirmed in the hard data. Right, back to the central bank drivel. It's still coming out in floods. Will somebody make it stop? ECB's the cost feels more confident that the trajectory of inflation might lead us to target. There is a negative GDP reading possible for Q3. His preference is for QT to remain gradual and predictable. Bit of a different slant from one of the hawks, ECB's Nagel of Germany, Bundesbank, saying that pausing could be an option. The inflation beast is still there, but to a certain extent, we have tamed the beast. The Germans are always in the most hawkish camp, but that's a little bit of a easing of hawkish rhetoric. One could call it dovish even, as far as Nagel is concerned. Another hawk, Kazakhs, who's turned recently, saying, reaffirming that current rates are appropriate to reach 2% inflation in the second half of 2025, but we can't close the door on hikes. He thinks we should discuss, or they should discuss, an early end to PEP reinvestments, i.e. increasing QT, etc. ECB's Wojcik doesn't see the need for rate hikes if the outlook holds. Another hawk, Hawky Holtzman, says could see stronger inflation than expected. Says nothing should be excluded on the rate path. ECB's McLuff says if we need to raise rates again, we will. ECB's Wunsch says maybe we've reached the peak in interest rates. If inflation meets forecast, no more hikes will be needed. Over to the Fed and those clowns. Fed's Bowman ready to act if inflation is seen increasing again. Tighter financial conditions allows for a bit of patience. Fed's Waller says higher for longer rates are seen pushing up longer term yields, which are now coming down again. Issuance clearly has an impact on yields. Very bullish on the economy, says we could see Q3 GDP growth of over 4% and says the economy is really booming. Not so sure about that, but it's not busting either. So we shall see whether he's close to the mark on those GDP forecasts. Also says financial markets tightening will do some of the work for us. So again, really reiterating what a lot of these guys are saying, that financial conditions are doing some work for them, as are the higher rate expectations, yields, so on and so forth. Almost like a rate hike, if some are to be believed. Bostic, stalling inflation would signal the need to do more. Now, he was one of the first pausers on that. I'm not saying that that's a real hawkish twist to his comments. It's more a case of, what would get them hiking again, because he has been fairly neutral and pausey of late. It says elevated wages are following inflation, not leading it. Well, I guess that depends on what the inflation rate is. Real wages are now positive, so if they remain high, they're going to influence inflation at some point down the line. Fed's Collins, we are likely close to or possibly at peak rate. Too soon to say if the core inflation is on trend for 2%. We may have to hike again if the data calls for it. We also had the FOMC minutes out, which largely passed under the bridge without much fuss. The long and short was that all officials agreed the Fed can proceed carefully and that rates should stay restrictive for some time. So nothing new in that that we hadn't already heard, or from the FOMC, or from a ton of Fed speakers since. PPI data was a bit of a surprise yesterday. pretty volatile in the end, really. Headline PPI coming in 6 pips higher, beating last month, beating expectations, jumping to 2.2%. The core number as well, up 4 points over expectations and 2 over last month. So it's always worth noting that PPI can be a bit more volatile than CPI, but it certainly put us in the upward camp, which got the market a little bit jumpy. We're going to see it's not going to be such a surprise today if CPI is higher after those PPI numbers. But I think the price risk is pretty well balanced both ways on that. Let's have a look at the CPI due today, just so we know what numbers we're talking about. So CPI expected to drop a pip to 3.6%. The core expected to drop 2 pips to 4.1%. Okay, so now after those PPI numbers, the market it won't be so much of a shock if CPI went up as opposed to if PPI was down and CPI went up. Same formula really, probably look at this 2 pips either side of the number. Outside of that, we get a bigger reaction. So if it comes in 3.4, 3.8, anything around that or outside of those numbers, then you're going to see a bigger move in pricing. Same for the core. If we go higher than last month, 4.3, then that's going to be a little bit more hawkish, if you like, for the Fed. If we're below 4%, say 3.8, that will take some of the pressure off. We could have a situation, it's worth noting also that these can move not necessarily in the same direction. We've seen it where CPI came down and core was still going up. So it's not a question that they both may or will move in the same direction. We could see CPI going up and we could see the core confirming at 4.1%. So that we also need to keep an eye on as well. But as I say, the reaction yesterday in prices over that PPI data was very telling. We were talking about it on F.A.C.E. I was favouring hitting a dollar rally. I didn't get anything, any levels that I was happy to hit. So I was looking at maybe dollar yen up to sort of this 20-30 zone, which it managed to get to overnight. Not when I was doing the data, but I didn't get anything, as I say, that tickled my interest in hitting any of my levels. But the reaction was pretty much the same. We got euro dollar, we got some dollar strength initially on the data, but it didn't last. And then what happens is we go and we make fresh highs and then we turn it around. I was explaining to one of our gents in the room who was saying, you know, sometimes you see a reversal in a price and then it goes further on. And that's something that is prevalent over data. I've been feeling all through yesterday that, you know, the dollar was likely to get hit or that dollar weakness was going to persist, but we did nothing. We waited and then we got over that PPI hump. The event risk got removed. That gave the pressure, let the pressure flow. That gave the euro the chance to push up to new highs. Hasn't gone very far, let's be honest. It didn't even manage to get to well, this morning it nearly got to 106.40. But yesterday just about managed to tick 106.30. So it's still cold, very tight here. It's still not ready to rock and roll. But it's keeping this momentum going, if slowly but surely, off the bottom of that 104.50 area. So I'm still pretty bearish on the dollar in the short term. I'll be looking for the similar reaction on CPI. If we get hot CPI numbers, we're going to see the dollar get bought up. If it's a decent enough bout, and I want to see something decent, I don't just want a 15, 20 pip move, then I'm potentially going to look to fade it because I think dollar is a rally seller for now. Yields, we obviously need to keep an eye on those as well. Again, didn't do an awful lot over the data yesterday. You know, no real big move there, but we're still edging lower. So we're still not quite ready to find a bottom. We may get a bottom around somewhere between 4.5, maybe down to 4.4, 4.3.5, depends. we may have seen a bottom. I'm not sure yet. What I definitely think is we may see a firmer top around 4.7. So if we do get strong CPI numbers, we get a bounce in yields. If it gets up there, can't get through there, find resistance into 4.7, that's going to be my signal to maybe start selling some dollars at that point. So lots to think about for this one. Depending on whether you're a dollar bull or a dollar bear, you need to know what the data is going to do. If you want to see the euro falling, then you don't want to see it getting above and holding above 106.30. That's a line a lot of people are looking at the moment. So again, we may just be pausing before taking another leg. If CPI is confirmed higher, we get a dip, the market's happy to sell dollars on that, then I would not be surprised if we do suddenly move up and break that high and maybe tick on up towards that 107 level. But given the price action over the last couple of days, I don't think it's going to be a straight line up there, maybe more of a grind. But the CPI data is the bigger number, it has to be said, so it may have a bigger impact in markets. Coming over to dollar yen, and we got to move up to 2030, and I was eyeing this area to see whether there was anything more left over from what was done after the jolts, and didn't they intervene. We did have a move through not long after that on Friday, obviously NFP and everything involved in that, but since then this 2030 still a sticky level. We couldn't break through it yesterday, can't break through it this morning, so it is a strong consideration to pay attention to if we get above there. And it is possible, again, if we get a strong CPI number, the key will be, can it hold? If we go up to, you know, these highs, 50s, 60s, it only lasts a few seconds and then we're back down again. That's good. This level will probably come into play again. It'll probably firm up as resistance once more. Again, that will reaffirm my thoughts that maybe we're seeing a bit of dollar weakness creeping in. But if we do get and hold above there, then it's still all about this 150 level. So I'm more inclined now to hit a rally in this one if I see one, rather than sitting on my hands as I have been all week. I've not actually traded all week yet, just because I'm not getting my levels, and it's fairly quiet, low volatility. I'm just not going to go chasing a trade. Cable. Over that data, it's taken itself back under 123. So this is looking like a bit of a fake out or a double fake out, however you want to call it. Unless we get below 122, 60, 65, though, the trend remains in play. So if we get a dip down here on strong US data, that might be a consideration if you want to short the dollar or if you want to go long the quid. If we can't get through that level, then maybe that would be the springboard. A third move back above 123.10 odd might look like it wants to push higher from that point. But then we've got some small levels in the way. The big point is still 124.50. Got the fib up there from the move down. And it's that old level we've been talking about for so long, that always seems to have a say in the price patterns that we see. So that's the doozy level there. If you get up there, you've got to ask a question what the market wants to do with it around that. Oil, going to have a look at as well. We've had a few oil bods out today. Saudi Energy Minister saying that we will continue the voluntary cuts until the year's end. So a few others, Novak and the like, talking a load of hogwash about how the market sets prices, not them fiddling with their production levels, of course. It's the market. Long and short is, it sounds like they're just coming out with some comments to keep things propped up. Oil closed the gap for all you gappies out there who like trading gaps and whatnot. What looks significant, though, is that we made a low above the prior low. So price action wise, this could mean that we're solidifying this low down here, this bottom down here. It's still short term, still a lot of work to do, but You know, we always talk about if you want to catch that knife, you need some evidence that points to that. Well, that's a low, and then that's a high low. You know, that's the sort of evidence you want in your locker. What it's got to do now, though, is get above this 84, 84 and a half, 85 area, just to put us back into this zone. If we do that, you know, it's still not out of the woods. It still had a big dump off. It's looking a bit like yields as well, you know, coming off the highs. But small steps, get above 84, 84, then we're back into this zone, and then we need to break above the highs there and, you know, around about this 87, 88 level again, just to take the pressure off and turn around some of this. So for me, it's still in the balance on this one, which way it wants to go, whether it's further down or back up again. Just watch the levels. And on that front, dollar CAD, another one, you know, oil related, looking a bit of a similar picture, just going a bit of sideways at the moment. I am still interested in hitting a rally in this one. Maybe the CPI will do it today. Wasn't interested in anywhere 36.20 yesterday. That's just me. I like to have my levels and stick with them rather than go chasing it. But I was getting a bit of FOMO yesterday, particularly with the euro dollar in the afternoon. I had to go for a little walk around the block just so I didn't do something stupid. All else, euro sterling, it's looking as we've got this short-term downtrend. It's very short-term, just for October, and the high of that is coming in, depending on how you want to draw your lines off these levels, round about where we are now, this 40 level. So we can't get through that. So we're keeping the downtrend on. Ignore that wick there. That's not a real wick. That looks like a broker roll wick. So the low was about 16. I'm still interested in the 86, 86, 10 level for a potential just a short-term little scalp off of that level. But I am mindful of this trend. If we get down there and the bounce is only limited to, you know, 20, 25, then I'm going to be a bit cautious that maybe we're going to have a move through. Then I want to see this tested and holding a couple of times before I have real confidence that this level is going to hold and we're potentially going to bounce from that. I'm still core long anyway, so this will just be a short-term play, just for something to do, really. Dollar China, another one not going anywhere significant. Pretty much glued to in the 729s, 730s. That press piece about their GDP, not bringing out any moves any which way on that one. Dollar MEX, everyone's looking at this. Has the carry trade ended? Well, it doesn't look that way at the moment. We're seeing, you know, that's a significant move off that resistance there. I know Blake and Kay pointed that one out. It has been very strong, you know, but it hasn't undone the trend just yet. 1740s, 1760s areas again, so these old levels are going to show up. 1740 is probably your main level. If it bounces off of there, then it will look like just a refresher. And if we get another move to 1850, I'd be there. I'll be cautious then about whether we get a break of that one. But yeah, it's been a decent move. But when you compare it in the longer trend, you know, not even getting to the 38.2. So all your carry traders from up here, all your shorts from up here aren't worried about this. Everyone who was jumping on late on the carry trade around here, they're worried about this. Which is likely why that accelerated higher as well, because all these lot panicked and got out. But if you've been sitting in it a while, you're not worried about this move just yet. You'll start getting worried if we get above the 38.2 and challenging the 50. And again, if we get up there, maybe a break of the 38.2, you might again see a bit of an acceleration, because all those in this area who are short on this pair on the carry trade will start to maybe park some stops in, maybe just above the 50 fib, that sort of area. That's when you get an acceleration. So the touch paper may have been lit for this one. We have to see whether it's fireworks or not just yet. Come on, folks, help me out here. I'm on my lonesome. Let me know what you want to talk about. I know you're all here. There's 48 of you sitting here watching. Yeah, some of you must have questions to ask rather than me waffling on about stuff on my own. Gold. Got close. We've had a close move back up to that 1885 that I've been looking at. This could be a bit of a maker or breaker for this bounce. Again, it's looking similar to a lot of, it's looking similar to a lot of dollar pairs, Euro, Cable, Aussie, even to, what was I talking about just a minute ago? Dollar Mex. It's this bounce after a significant move lower. It needs to take out the levels. If this is real, it needs to get through 1885 and probably as a confirmer 1900. Do that, we go back into this traffic zone, and this is just a short-term blip in what was going on in gold, which was pretty much sideways, as you can see. So that'll put us back in the range, maybe for more range trading. If we can't get through here, then like the MEX, we might see quite a decent pullback. If it gets back below, if that happens, it gets back below 1850, that's probably a bit of a break line. If it gets under there, it's probably likely to undo a bit more of this rally. And then we need to see what happens. Does it get back to the lows? Does it pull up short? If you're looking for tech perfection, if it's going to fail up here, you want it to pull back to probably somewhere like this 1832, find that as support, then you're going to get probably a kicker back towards the highs. So this is the line for me, 1885. That's my marker in this one. Aussie Kiwi, Gavin, good one. Let me see if I can find it. I really need to tidy up this crap. I've got all my charts. Where is it? There it is. I need to put stuff in order. Yeah, that's looking like a little bit of a fake out. I know you were looking around this 1620 area for a bit of a long down here. You've had a bit of a bounce. It's not looking decisive, this bounce at the moment, though. It's got itself, close to getting itself above this trend line. If it does that, then maybe you get a bit more of a bounce down here. I haven't touched it myself in the end, but it's definitely looking like it's holding at least into the big figure. And I know some of you guys had some tech down here as well. But yeah, it needs to hold this trend line, get back above that trend line. We've had these little fake moves below before, and then right afterwards it's come back and held. So it needs to be respective, but can it get back to the magnet line at 108? At the moment, looking at the Chinese stuff as well, there's a bit of influence there. The way the market is now seeing Chinese stimulus as a positive, that will potentially play into a positive for the Aussie, but also for the Kiwi as well. Just Aussie being the bigger economy, we'll see the larger effect from that. So if things turn around more positively for China, then that's going to be another reason why the Aussie might get a spark of life in it. But for now, Kiwi just seems to be the one that economy fundamentals just seem a bit more bullish on that front. Giuseppe, Kiwi Swiss. Well, you did pick them up. I asked for it. Let's have a look at Kiwi Swiss. Oh, there we go. I've even got it on my chart. Let's see what I've got on there. So again, similar pattern, similar pattern to what we've seen. Dollar Mex, talking about big, strong trend, a bounce, hit your first significant level, can't get through it, and then you get a pullback. This one might have a bit more room, maybe down to the 53s on the Kiwi Swiss. Obviously, you've got to watch what the S&B are up to, because they're lurking behind the scenes for any untoward moves. But the fact we pulled back from that, then bounced, then made a new low, it doesn't look too hot. I don't know what side you're looking at, Giuseppe. But this looks a bit more bearish now. You know, we've had that failure, the dip, the bounce, didn't get back as high. Then we broke a new low. So we seem to be looking a bit more bearish in this one. But, you know, the trend is still your friend from this one. I haven't got a fib on it. If I put a fib in it, it's probably going to come in around, what, 53, 70s, 60s, something like that, the 38.2. So if you want to fib that one, that's your line, really. Whatever that fib is. Let's put it on. Come on, don't be lazy, Ryan. Now I'm going to just spend an hour trying to get the bottom there. Oh, come on. Can you get it? Boom. There we go. I wasn't that far off. 53.88. So that's there. If you know, from one fib to another. So this is more short term. The other one's longer term. So as I say, if we get to that fib and it holds, then maybe you get to see a bit of a springboard. But then you'll need to take out this high, 54.75.80. If it doesn't, it keeps the pressure on. And if you dip from there and the fib goes, then you're going to be doing a bit of a step down. And then you're going to be looking probably low 53s, the 61.8, around that sort of area. That's your sort of line in the sand. If that goes, then, you know, we're heading back towards the lows on that one. You're looking for a short. Yeah. Well, well, depending on your time frame, what you're looking at, you know where to be short. You know, got a level in here around 54.5, call it. Was a prior level. It's a bit wishy-washy now, so I wouldn't trust it that much. Although, let's have a look at the short time frame. You've got some signs that it's resisting again, but I'd be a little bit cautious on this one because it, as I say, it looks a bit wishy-washy now. So if you're going to look to get short, if you're not short already, up towards 54.70.80, above that, you don't need to put 100 pip stop on it. If it's off by 20, 30 pips, you know, maybe even less, 15, 20 pips, you know you're wrong. Or else look to see what happens against the fib. You can always go for a break. If it goes straight through it, then I'd wait for a confirmation, maybe a bounce back to the level. If that holds, then that gives you a chance to get into more shorts or get into a short. Or else you wait for the bounce. If it bounces, see what it does up top, see where the resistance comes in. As I say, if it can't quite get up there, if it hits that level and holds, then you've got a bit more conviction in the level, and then you look for a move back down there. So yeah, it's all a watching game, Giuseppe. You know, we'd all like it. If you're short, you all want it back down here, but that's not how markets work. You've got to work out what the market wants to do with it. You know, we might find a bit of resistance, a bit of support just coming in just on the basis of those prior lows there, but it's all round about the 38.2 anyway. Pound Kiwi. And you have to let me know. You know, I know a lot of you people trade all the, I won't call them exotics, but pound Aussie, pound Kiwi, and the like. What is it you see in those pairs that you like trading? Is it the volatility? Is it the techs? They have a good tech market. You know, because liquidity-wise, you're trading fairly low liquidity pairs. You know, there's not a huge amount that goes through these pairs, which can be, you know, a bit of an issue. If you do get a shock, you can get a bigger outsized reaction. But it always interests me why people pick these pairs. As I say, is it a volatility thing? I mean, it doesn't matter what you trade. Once you learn how to trade properly, and that's not guessing, that's knowing how to manage a trade, not necessarily be right or be wrong, but know how to trade against the levels. It doesn't matter what asset you trade. Knowing, you know, that's a support line. Doesn't matter whether it's pound Kiwi, pound gold, lean hogs, orange juice, whatever. Doesn't matter. Support is support. Prices are prices, whatever happens. But yeah, let me know why you trade it. Looking low liquidity, but looking to see patterns. So low liquidity means you're looking for bigger moves then when you do get a move. You know, compare it to something like euro dollar where, you know, it can sit in a 20 pip range all day. Something like this, you're going to get bigger volatility perhaps, and bigger ATRs and that sort of thing. But in the meantime, yeah, I mean, that's looking pretty clear. Again, another one coming off a big trend lower. You know, technically that's perfection. Hit a low, bounce, match that resistance, come back down, test the low. So now you know the range. So already I can tell you what's going on this, or why I think is going on in this one. There's your range. 2.0270s, 2.05 80s. If you want to trade in between that, fine. You can short up here, you can long into there, so on and so forth, back and forth, play the ping pong. But you can also go with a break. So even if you've been short and even you've got short bias, you can still go long, because technically you break above there, then you're potentially going to see some more upside. And if it holds, then that gives you a confirmation. Same on the downside. Break below it, you can either go with the first break or let it come down, bounce. If it holds that level again, that's your confirmation to get into shorts or add to shorts, and then you look for a further move down. But yeah, nice technical looking picture on that one. Gavin as well, look at them the same way as everything else. Zones, PA, etc., etc. Yeah, that's fair enough. I've been trading full time for, what's it, nearly 13 years now. And when I first went back to trading full time, I was looking at everything. You know, I would be going through all these pairs, looking for this, looking for that. You know, I had a hand in everything. But often I found I was looking at so much and not doing anything because I was waiting for this, waiting for that. And then, you know, this is just me personally. I can't look at 30 different pairs looking for opportunities hither, thither, because you look at one and you miss another. But, you know, doesn't mean I don't trade them. There's plenty of times when you guys will highlight something, or I'll just happen to see something like this. You know, this might get my interest just because we've got two big levels. It's simple to trade. You know, nothing complex about trading this one in terms of the techs. But yeah, and I guess over the last 10, 12 years, I just found I don't need to look at 80 different pairs to try and get my pips. I can just stick to, you know, 10, 15, which is enough on itself, and everything else, all the assets as well. And but as I say, it doesn't matter. You don't have to look at 30 different pairs to trade. You can look at one pair. The price action is all the same. The moves all the same. You get bounces, you get drops, you get support, you get resistance. So for those who are inexperienced, because I know one thing is a lot of you look at pairs to try and get a trade because you want to make a trade. But it doesn't matter what you trade. If you've got the fundamentals of trading right, knowing how to manage a risk, knowing what to do against that level or this level, and knowing what to do about not getting involved in the middle. If you know how to do that, it doesn't matter what you trade. You can trade any asset at all. The mechanics of trading is simple. What becomes interesting is why might the pound move? Why might the Kiwi move? That's when you bring in the fundamentals, the central banks, economies, that sort of thing, because that then tells you why this might break or this might break. That's what makes trading interesting. But yeah, if you want to keep it simple, I would say most people, you know, and lesser experienced people, stick to 4 or 5 pairs and maybe a couple of assets. S&P, like everyone likes to trade, or gold. Stick to 4 or 5. Learn how they work, because once you learn how they work and how prices move, how price action moves, you can apply that to anything you want. But yeah, all you love looking at different stuff. That's what makes this so exciting. Right, anything else for anything else before we move on? And I'll call that a day. Gavin says, learning one setup in and out then can be applied to any instrument. Yeah, exactly. It's all the same. There's buyers, there's sellers. And trading, you know, it's a 50-50 game. Price either goes up, price either goes down. That's it. You know, you don't get those odds even at a casino. Pound Swiss. We'll look at that one for you, Sad, because I know you wanted to look at it yesterday. Oh, why am I not scrolling? Let's see what the magic tells us on this one. Let's have a quick look. Right, what are you looking at? You want to go long on this one? Okay, well, what have we got going on here? We've got a bit of a support area, haven't we, around here? It's fairly tight. I mean, this is looking almost like, and those who remember, this is looking almost a bit like when the S&P had their pegging at 120 in Euro Swiss, where it just walked along the line, but didn't really bounce. This is looking very strange. You know, it is holding this support area down here. Maybe there's some official interest for this one. Who knows what the S&P are up to? So that's your risk level. You know, you've got one line. You know, you might have your own level where you want to tighten it up to. Let's, you know, my line's at 110.5, call it. So if you want to long it, that's where you want to long it, and you're 22 pips off, but you're going to need to be very careful on a break. We've had a couple of goes. It's held, but if it breaks, you don't want to find yourself down at 108 thinking, what do I do now? So you can keep a fairly tight trade against this one. These MAs are probably a good marker at the moment in where you've got to get above. So you know, at the moment, if you get in, let's say you get in at 110.60, then you're really only looking at 160 odd pips. That's where your risk level comes in. You know, if you don't get through that, that's potentially your maximum profit you're going to make. So if you're going to be longing in here, you want to be chopping some of the trade off up to this level. And if you hold this level, if you get up here and these prior highs and you can't get above, then you've got a question to ask. Maybe you just bring your stop up behind it into profit. So if it does come back down, okay, you get stopped, but you get stopped at profit, not at a loss. But yeah, it's looking a very strange chart, this one. I've got to say that. No real bounce at all, no real volatility compared to some of the other pairs. Let's come back a bit further. See what's going on. Yeah. So again, it is a bit significant, but I don't like the lack of bounce. That's my only concern. I don't like the lack of bounce. If you do get a bounce above these MAs, they're maybe going to move up to 115, and that's really your key level for further upside. But yeah, be very careful on the break of that one, Sab. Most definitely. Yeah, Darren, when it will happen when you least expect it. You know, I don't like a level being tested so often, but it's very rare you see a level tested this often, which again suggests there's something going on here that we don't know about. I don't know if it's some official bid, maybe the S&P have got some orders in from someone, or they look at this one and they don't want it sinking too far. I don't know, but it's very rare you get a level holding like that. But yeah, the breaks can be significant. You know, that 180 pips, you know, you don't want to be getting caught out on that. And you don't want to go offside and hope it comes back at you, and hope you get it back above the level. So, you know, I'd rather do 10, 15 pips trying it on a stop, and then waiting for it to come back and confirm again, than ending up 50 pips offside thinking, oh, it's just going to fake through and then bounce again, because that's when it drops down to 108 and then you're staring a bigger loss in the face. Oh, Darren, yeah, don't tell me about that. The S&B, yeah, there weren't many people who didn't get caned on that one. That's a different story, not for today. So anyway, right, keep an eye on that CPI numbers. Watch the reaction. The reaction is going to be important. Doesn't matter whether you're a dollar bull or a dollar bear. You need to watch the reaction. It will tell you all, same as it did for the PPI. And you know, when you're watching the data, that's what you want to learn. You want to be learning what the price does on certain data points. Has it changed? Are things as bullish for the dollar on strong numbers now, or are they not? And we'll get to see what happens later. And tomorrow we shall review it all and see what happened. Hopefully no burnt fingers from you guys. Have a great rest of your day. Thank you for joining me on the Flow Show, and thanks for all your valued input. Get your pens and papers out. Let's get some more questions coming in tomorrow. Otherwise, you're just going to be listening to me again. Have a great day, everyone. See you all tomorrow.